Good day, everyone. Today, we are going to dive into one of the fundamental financial statements used in accounting, the statement of financial position, also commonly known as the balance sheet. Let's start with the first section from our material titled 5.1. What is statement of financial position? This section gives us a concise introduction to what the statement of financial position is all about. Firstly, it tells us that the statement of financial position is essentially a snapshot. It provides an overview of what a company owns, which are the assets, and what it owes, referring to the liabilities, at a particular point in time. Think of it like a financial photo taken at a specific moment. Crucially, this statement is typically prepared at the end of a company's financial year, so the point in time is usually the closing date of the financial period. The statement is a key tool used to show how healthy the company is financially. By looking at what a company has and what it owes, you get a sense of its financial standing. As I mentioned, it's also known by a different name, which is the balance sheet. Regardless of the name used, it is considered a fundamental financial statement. The structure of the statement of financial position revolves around three key components. Okay, assets, liabilities, and equities. These are the building blocks of the statement. These components are not independent, they are related by a core principle in accounting known as the basic accounting equation. This this equation is assets equals to liability plus equities. This fundamental relationship means that the total value of a company's assets must equal the total value of its liabilities plus its equity. This is why it is called a balance sheet. It has to be balanced. Now, looking at the format provided on this page, we see how these components are typically presented. On one side, we list the assets. These are usually divided into non-current assets. These are assets that the company expects to hold for more than 1 year, such as property, plant and equipment, motor vehicle, equipment or machinery. Current assets, on the other hand, are assets expected to be converted into cash or used up within 1 year, like cash, bank balances, account receivables, inventories, or trade and other receivables. The totals of these two categories give us the total assets. On the other side, we have the liabilities and equities. Liabilities are what the company owes to the others, and they are also typically divided into non-current liabilities, okay, and also current liabilities. Non-current liabilities refers to the obligation due in more than 1 year, such as long-term loans, bond payables, or lease obligations. Current liabilities refers to the obligation due within 1 year, like account payables, short-term loans, or dividend payable. The sum of this gives us the total liabilities. Below the liabilities, we have equities. Equity represents the owner's stake in the company. It typically includes items like share capital, share premium, retained earnings, other reserves, and might show equity attributable to owners of the parent and non-controlling interests, especially in the consolidated statements. These add up to the total equities. Finally, the statement presents the sum of total liabilities and equities. As the accounting equation dictates, this total should always equal to the total assets figure. Now, let's move on to the second page of our material, which answers the crucial question, why the particular statement of financial position matters. This section highlights the importance of the statement of financial position and explains that it is important to different stakeholders, both internal and external. These stakeholders use the statement for various reasons, including assessing financial health, As we noted earlier, the statement gives insight into a company's financial stability. Stakeholders can look at the balance between assets and liabilities to understand the company's solvency and liquidity. Number two, comparing performance. Users can compare a company statement of financial position over different periods, like a year-to-year basis, or compare the statement of different companies within the same industry to see how they stack up financially. Third one, investment decisions. Potential investors use the statement to evaluate a company's financial structure before deciding whether to invest or not into the company. They might look at debt levels or asset composition for that matter. Reason number four, regulatory compliance. Companies are often required by regulatory bodies to prepare and submit their financial statements, including the statement of financial position, to ensure transparency and compliance with accounting standards and legal requirement. Okay, and finally, the fifth reason, internal decision making. Now, within the company, management uses statement of financial position for various internal decisions. For example, understanding asset levels, help with the resource management, and analyzing liabilities is key for financial planning and risk management. So as you can see, the statement is far more than just a list of numbers. It's a vital report that provides a clear picture of a company's financial standing at a specific point in time and serve multiple critical purposes for a wide range of users.